Hello, everyone. Thank you so much for joining us here at CPA Academy. We are so excited to have Carl and Maggie over at Leyton here. I'll be handing it over in just one moment. Before I do, we're going to do a few housekeeping items. Check in with you, the audience, make sure everything's working for you. Make sure you can see the webcams, the slides, make sure you know how to use that questions pane. Let you know about your CPE CE credits. Let's get started. If you wouldn't mind drawing your attention over to the GoToWebinar control panel, usually on the right side of your screen there's a question pane. My screen's starting to fill in with all the people from all over the country that are joining us. So if you hadn't already, please say hello. Let us know what brings you here today, what interested you in this course. And then if you'd like to let us know where you're joining us from, that is fine as well. If you have any questions for Carl or Maggie, the Leyton team, please post them in that question pane. If there is time at the end, we'll do some Q&A, but we will also be sending a full report with all those questions to you. And there's also going to be some support on the line, typing responses to your questions as we go. This is a 1-hour course eligible for 1 CPE or CE. In order to get that credit, you need to do 2 things: attend this full session and answer the polling questions. Those polls are going to be launched periodically. You just need to select the radio button that best fits your answer, submit, and you're good to go. We'll do our best to get your credit processed a little bit later today, but you should see it in your account by tomorrow. We will be recording this session. We'll make that archive recording available. And let me check in now. My screen, once again, big class here today. People from all over. We got St. Louis, West Virginia. We've got Virginia, New York, Colorado, Illinois, Texas. Perfect. Looks like things are working well, which is my cue to step aside. So Carl and Maggie, thank you so much for being here today. And thank you so much to Leyton for sponsoring and presenting. The show is yours. Thank you so much for being here.
Thank you so much. And thank you so much for those who are joining the session today. I see we have someone from Stuart, Florida, amidst a hurricane. So I guess this is the perfect thing to do and amidst a bunch of rain. We are excited to talk to you guys about probably the hottest topic in tax as of the last couple of years, the employee retention tax credit. And our hope today is to clear up some common misconceptions and myths and talk about our approach to the credit and help to guide and advise those of you who are taking on the credit yourself. And if you're not doing that in your firm, then we're here to explain to you how we approach it and then hopefully help you and some of your clients out. We know that there are loads of questions around ERC. We've done, we hope, a good job in getting a lot of those addressed in our presentation. We do have Ben Brissett on the chat to answer live questions. So please don't be shy. As questions come up throughout the chat, we will get what we can answered. And then if not, as Nathan had said, we'll be emailing those out and we'll set up phone calls with you guys. We are going to drop a link in the question box for you guys to schedule time to meet with us. We'll drop that a few times. We know questions flow through it. It's hard to see everything. So don't be shy. We want to chat. We want to share the love and the expertise when it comes to ERC. So we'll start today by giving an introduction. I'm having trouble actually. There we go. So my name is Maggie Crowley. I am head of strategic development here at Leyton, and the strategic development team is responsible for our partnerships with CPAs, associations, and other sort of affiliate members. So I have a number of years experience in creating, cultivating, and building out partnerships. I've been with Leyton for about 4 years and have developed and built out our partnership channel. And to my right is Carl Sussin, all the way from San Francisco. He's here in Boston in our headquarter office. And I'll hand it over to Carl to introduce himself.
Thank you, Maggie. So, hi, I'm Carl Sussin. I am a tax consultant here at Leyton. I'm also a tax attorney by trade. I originally came from the Big Four, spent a couple of years there, and I've been at Leyton for about 1.5 years. I think a little bit over a year ago, we officially kind of got our first clients for the ERC. It's, as many of you have handled it or looked at it before, it's changed in many ways. And so I think that this presentation is really important because it solidifies many of the rules that we've kind of looked at and seen and made sure that we're in sort of compliance with. As you know, the IRS is increasing sort of the number of audits And so we want to make sure that all the rules that you have and sort of are in your knowledge are the correct ones. So going forward.
Well, thank you. Let's review our agenda real quick. So we're going to give a summary. We'll figure out who can qualify, and we'll speed through some of these. This is like much of what people know, but we do want to make sure we're covering it for those who don't. And then the eligibility for significant decline in gross receipts, and then also the same for government shutdown, determining what are qualified wages, aggregation rules. That's definitely where some of the confusion can come in. Interaction with other tax credits, including PPP loans, and then recovery startup path. And then we do have some examples, which we tend to find the most engagement with when we do these sessions through examples. So we work with thousands of clients on multiple different tax engagements, and over the past 2 years, loads with ERC. So we've got some pretty interesting examples to share, some complex ones, and we're happy to do that. So I think most people are aware of what the employee retention tax credit is, but it was in response to COVID, and it is a government incentive with the idea to help businesses get some relief from the trouble they got into during COVID financially. And this is intended to reward those who kept employees on and paid them even though they weren't able to open their doors completely, or if they had to do a partial shutdown, and also if they had a significant decline in their gross receipts and their profitability. So the rules in 2020 were a little bit different than they were as far as what you can get back in 2021. In 2020, the max claim was $5K, and then it was bumped up to $7K per employee. And so now we will get into a bit of the actual distinction between who can actually claim the ERTC.
Yep. So in terms of who can claim the ERTC, the IRS is very, very specific, and it's just about any type of business. However, there is sort of the exception of U.S. government entities and quasi-government entities. And so in this kind of thinking, the IRS wants to essentially help out all sort of struggling types of business. But of course, those that were part of the government were already sort of benefiting from government support. So that's kind of their sort of idea in terms of who can claim. There's a lot of sort of misinformation about this, but it's safe to say, and this is from the IRS FAQ on ERTC, that it's just U.S. government entities and quasi-government entities. So quasi-government entities are just entities that act in sort of a similar public function to the government. And so there's a set test, and it's basically, do they act, and is their role and is their performance just like the government? That's kind of the way to kind of think about it. Employers of any size, there is no sort of hard cap in terms of what the maximum credit is. There is a soft cap with the large employer rules, and we'll get into that later on. Tribal governments and tribal entities, employers operating in U.S. territories and commonwealths, and all of those entities can claim the ERTC. Now, one thing that you do have to be careful with is self-employed contractors and household employers. They are sort of prevented from claiming, and you kind of think about it that the ERTC came from payroll taxes. And so those entities don't actually pay payroll taxes or pay a different sort of set of taxes. And so the IRS is essentially prevented those types of businesses from different types of rules from claiming it.
Makes sense. Oh, sorry guys, our mouse here is not working to click the slides.
Yeah. So again, kind of how do you claim the ERTC? So the IRS originally started out with two main paths. So that's the declining gross receipts, and that is the government shutdown. Those are sort of the main paths that we kind of started out with. But later on in 2021, the government also released what is called the recovery startup, and that's sort of to reward companies that started during the pandemic. And we'll get into that in a little bit more detail later.
Carl, do you find when working with like our CPA partners and also our clients, are they aware of these differences, or is it like always a pretty big education that we're providing to clients and partners?
Yeah, so I think that at least for declining gross receipts, the main rules are pretty well known, although there are a bunch of little subset rules that people sometimes have trouble with. The big one that I want to highlight is the government shutdown, as that's probably where we see the most misinformation, just because the government shutdown, unlike the declining gross receipts, is a facts and circumstances test.
All right, and with that, we'll move into our first poll, Nathan. I guess just let me know when you've launched the poll and I'll read it.
All right, we've launched poll
Poll's
number one.
open. All right, what type of entity cannot claim the employee retention tax credit? A nonprofit private school, a federally recognized tribal government, shipping company based in Guam, or a federally qualified health center? And you've got 60 seconds to answer this. Let the games begin, folks. Each time we do these, I say we need music. We do need music. We didn't bring it this time either.
I can sing for you, but I'll just say we have already been about 40 seconds. We'll give everybody about 20 more seconds here. Make sure everybody has a chance to respond.
All right. All right. Now let's see. What do we think the answer is going to be? We got to open up our poll results here.
All right, get those last couple of votes in and we will close and share those results.
Okay, so 20% said our answer number one, nonprofit. 24% said federally recognized tribal government. 34 said shipping company, and 23 said healthcare center. Carl?
Yeah, so the right question is the
right answer.
federally qualified health center. So essentially, private schools are able to claim the ERTC just like any sort of nonprofit company. Federally recognized tribal governments are also allowed to. There's a specific caveat in the ERTC FAQ that allows them to claim it. Shipping companies based in Guam. Now, kind of going into this, you look at who can file a 941. And there is a sort of the regular 941, and there's also a 941 that is designed for US territories and commonwealths. And so this kind of allows companies, as long as they pay that sort of payroll tax, they are sort of able to claim the ERTC. But the federally qualified health center, now those are essentially running as public hospitals, but sort of privately run. So they are still acting in sort of that public service in either rural areas or in sort of financially deprived areas. And so those would be a bit too close to what is considered sort of a government entity. And so that kind of falls within a quasi-government entity.
All right, thank you. So let's talk about declining gross receipts. Who's eligible for that?
So as long as you hit the sort of measures that the IRS has, so that's 50%, more than 50% in 2020 or more than 20% in 2021, you are sort of eligible to claim the ERTC. We've included just a few of the sort of main items of income that we have seen that are included as income for the gross receipts purposes.
And what about a decline in gross receipts, or what about a significant decline in gross receipts?
Yeah, so again, that's the significant decline in gross receipts. The IRS has deemed to be that 50%. So it has to be that sort of more than 50% decline. And you use 2019 as sort of your base year to compare. Kind of think of 2019 as sort of that year before COVID hit, and then 2020 and 2021 as sort of those periods and times after. In terms of 2020, it's a little bit funky in sort of the rules. Once you hit that first margin of the 50%, it then increases, and you just need to have sort of 80% of the gross receipts that you had in 2019. So it's easier to meet once you hit that original threshold.
All right, I think we need a little example. So eligibility example.
Yeah, so just kind of here, as long as they sort of hit that first calendar quarter, essentially it starts almost like a sort of a ticker for the different periods of time. And then essentially the bar shifts to that that 80% sort of threshold. And so we always sort of, when we do our analysis, we compare first hitting that 50%, and then we have sort of in our systems, it reaches up to that sort of 80%. And it allows sort of companies that dived, especially specifically in sort of one point of 2020, to suddenly be able to sort of meet additional quarters. And that's found also within the Notice 2021-20 and the IRS FAQ on ERTC.
So 2021 was a whole different year, and some of the rules became a little bit different.
Yeah. So essentially here, the IRS kind of thought that most companies would have already sort of partially recovered, but they still were affected by COVID, and they were still sort of paying employees during these periods of hardship. And so that period of hardship, that declining gross receipts is much easier to meet in 2021. And you'll also notice that the benefits of getting the credit in 2021 are much higher than 2020. There are several additional rules, and we can get into that in a few slides.
Awesome. Thank you.
So the most famous rule is the alternative election rule for 2021. Similar in kind of theory to that sort of bonus quarter from 2020, you are allowed to elect to use sort of the previous quarter if it was eligible. And so you kind of think about it, let's say I qualified for Q1 on its merits in 2021. Well, you can elect, even if you don't hit that 20% in Q2, to qualify for Q2 using Q1's declining gross receipts. So it's almost sort of like a bonus reward for that sort of hitting that hardship threshold. You can essentially get a second quarter. That's why usually we find that declining gross receipts is the more beneficial of sort of the two main paths of government shutdown and declining gross receipts.
Interesting.
So, just going back to Notice 2021-23, when sort of dealing with a company that began midway through 2019, the IRS does have several permissive rules. You can essentially drag the decline back and sort of benefit for those sort of times and periods.
We always get so many questions, especially on like the business development side, on the eligibility of what actually qualifies as government orders, and so we can walk through that. That'd be helpful.
So this is probably one of the biggest areas that has a lot of confusion and sort of miscommunication. A lot of businesses will originally say, hey, I was affected by COVID, but the IRS says not so fast. Specifically, you have to be following a government order, and that government order had to have restricted commerce, travel, or sort of group meetings. And so that's kind of why we look at like stay-at-home orders and things like that for that sort of qualification period. And we'll go a little bit more into detail on exactly how we do those things in a few slides.
Okay, awesome. Any further elaboration on this, on the slide about examples?
So these are just some common government orders that we have seen through our whole sort of ERC process. These include essentially non-essential business versus essential business, state emergency proclamations for shelter-in-place orders, curfews, and things like that.
Another hot topic or area of discussion that we hear often is the difference between essential and non-essential. They vary state by state on what was essential and what was not essential. So this is where we do see loads of confusion.
Yes. So essentially, the first question that we always ask was your business essential or non-essential? Usually the government orders will have specific caveats for the treatment of these types of businesses. And that's usually sort of the first hurdle to meet. If you are a non-essential business, for the most part, you were required to sort of shut down and stay at home order. If you are an essential business, it becomes a little bit harder, but as you'll see later on, there are sort of partial shutdown options that we can sort of qualify. And this kind of goes back to that whole idea that this is a facts and circumstances case, and you're basically telling a story to the IRS that, hey, we were hurt by the shutdown. We may not have shown it in our declining gross receipts, but we were affected by the COVID stay-at-home orders, essentially.
Just a nice segue into the how to distinguish between the full or partial suspension.
Yeah, so we've just kind of have a list right here of different parts of the sort of full or partial suspension orders that we have seen, sort of transitioning to telework, portability of employers' work, need for presence. So these kind of just mainly fall within sort of the fullest suspension, but you'll see a bit later that there are sort of additional sort of safe harbors for that partial suspension. Now, we're going just touching a little bit on aggregation group. We're going to go back into this in more detail, but one of the benefits of the government shutdown versus the declining gross receipts is the idea that if one of your businesses was shut down, they all can claim it. And so this is specifically found within the IRS FAQ if you have sort of additional questions on this. But this is one of the most powerful parts of the sort of aggregation government shutdown interaction.
All right. Let's run through a couple of tax saving or a couple of scenarios. We always find that bringing it to light about an actual business taking advantage of this can be, bring it all home.
Mm-hmm.
So we worked with a restaurant group. I think it was a pretty decent size. They had 11 locations in the Western US. They had 350 employees and 150 were full-time, and they got back 1.673 million in credit for 2021. I think we have some additional information on this later in the presentation, but the large employer and small employer scenario is really where we see a lot of confusion lie. I mean, there's loads of confusion throughout all of ERC, but especially with this, how to actually figure out who's a large employer, who's not. And this is a nice example because it sort of teeters on almost being large employer.
Yeah, for 2021. So in 2020, the threshold is more than 100, but we'll get into that in a bit in terms of sort of like details.
But as you can see, this is a pretty powerful tax credit to be able to take advantage of. 1.6 million
Yeah.
for a business that had to shut down.
Yeah.
Maybe could take advantage of like online ordering or whatever. It's still very useful.
But we can say that these types of businesses were specifically what the IRS envisioned with sort of the standard government shutdown in helping them claim to sort of reward them for keeping Americans employed during the pandemic.
Makes sense.
So just kind of going in how we treat the government shutdown for the ERTC, we always look at those sort of specific government orders first. Once we see whether or not there was a specific order for a specific state, we then sort of go through the analysis. And again, it's always sort of a facts and circumstances case. So we look at sort of building that story of showing that your business was shut down, was affected by COVID, essentially.
So to put that into perspective, for instance, if the state of California had issued a government order for all non-essential businesses to close from March 19th to June 4, pursuant to the order employer, which operates a non-essential business in California. So this is, the type of information that we've taken the time to research. We've built out a long list of information like this that can really help and speed up the process when working through a study for an ERC study.
Yes. And I just want to sort of highlight here that this is one of the areas that we see the most sort of misinformation. Essentially, you have to match your sort of shutdown period to the government order. So in this particular case here, you had June 30th. That sort of period of time between sort of that June 4th to June 30th would be what the IRS would consider a voluntary shutdown period. So this is where if a client was still shut down, they're essentially not going sort of with the rules. And so they can't claim this period, even if they were specifically shut down, because the IRS wants us to only look at those exact sort of government shutdown dates.
All right, Nathan, it's your turn to launch the poll. What is the minimum number of weeks required for a company to signify to the IRS that they had a significant delay in their transition to teleworking and thus are able to claim for the government shutdown path? Polls are open, people.
Thank you so much. We'll give everybody about 30 more seconds or so.
Carl, can you provide music? Can you sing?
No.
Where is the poll on our screen?
We have 1,100 people.
Yeah, we sure do. 1,103. Thanks, guys, for tuning in. And there are, again, if you want to schedule time to have a deep dive with an ERC expert from Leyton, book a meeting. We're happy to talk.
Thank you so much. We'll give everybody a few more seconds, get those last couple of votes in. And we will close, and I'll share those results and go back to Carl and Maggie for the answer.
All right. You know, we can't actually see the poll. Do you mind reading the results?
Yeah, so the response we have, 19% are saying 0 weeks, 24% 1 week, and then 57% more than 2 weeks.
Carl,
Okay.
give it away.
So the correct answer is more than 2 weeks, and this is found within the IRS FAQ for ERTC, specifically in sort of their teleworking 4-point area. And so essentially here, what the IRS is saying is that we understand that some businesses, like let's take a school, had a period of time that took them to transition to teleworking. And so we're willing, as long as it's more than that 2 weeks, we are sort of willing to allow that to be claimed as government shutdown period, but only those specific 2 weeks. So you first have to essentially match it with the sort of government shutdown order, and then you can sort of use that 2 week time within that period of time, essentially.
All right. Well, we're not done talking about the eligibility for shutdown.
Mm-hmm.
Now we'll move into the government orders and partial suspension.
Yeah. So this is sort of that safe harbor. And what essentially is a safe harbor is that the IRS understands that not all cases will meet sort of the standard orders. And so they've created several examples, and we usually have to run through every sort of example and see how closely it matches with a client. But before you even get into that, there is sort of the nominal portion that you have to meet. And this nominal portion is that the gross receipts has to be no less than 10% or hours of service 10%. Now this sort of nominal portion is sort of specifically tied to sort of divisions or sort of businesses within an aggregation group, and you have to show that there was a significant hit to some part of your business, and then sort of match it to the examples.
For instance,
yeah,
we have an example here of a company with 3 divisions who Carl worked directly with them, so I'll leave it to him to describe what this looked like there.
Yeah, so essentially we had a company that had 3 different divisions. No, they weren't named Division A, B, or C, but essentially they had sort of different sort of parts of their business. And you can tie this again to the gross receipts. The IRS is specifically strict with this because it's in the rule set on sort of what you have to meet. And so essentially here, Division C alone would not be able to meet the nominal portion because it's less than that 10%. So it's a very sort of minor part of the business, but that Division B or that Division A would meet it. Now, essentially here, you have to sort of tie it to some, we recommend at least that you tie it to some sort of number, because you always want to have a paper trail when you're dealing with the IRS. Just so if in case of that sort of audit, you have that sort of defense to back up your claim and say, hey, this is why I was able to claim it. You guys specifically in your rule set that you set out to the public specifically had this, and then my example is very similar to yours.
We've found there's a lot of gray area within identifying which businesses qualify. So we've got some examples here of ones that we have successfully qualified, ones that should, and then ones that are they have the potential to, but haven't necessarily had a successful claim just yet. So as you guys are looking at your book of business, if you're a CPA, or your own business, if you're a business owner joining us today, ones that have successfully qualified are in the food industry, the entertainment industry, tourism industry, fitness, hotel, retail, and staffing agencies.
Yes. So these are sort of the businesses that the IRS directly envisioned would be sort of affected by the government shutdown. You can kind of think about it that all of these businesses have sort of boots on the ground. They can't transition to telework, or they'll have a very hard time of doing so. And so they specifically need sort of a place of business and have sort of that physical presence in that business. And those businesses were mainly ordered to shut down because they weren't essential. And so we've seen our sort of greatest success in terms of qualifying a company in these sort of group right here. But we have had additional success, and we can go on to the next slide, where we have, again, these sort of businesses could be qualified. Specifically, if you kind of look at it, many of these will fall within the sort of partial shutdown rules. And there are specific examples for a lot of these. And that's kind of where we attach sort of our client situation to the examples that are listed in the IRS in the different notices, or in the IRS ERTC FAQ. The possible ones are a bit harder to get, but we have been able to sort of successfully claim. In one case specifically for financial firms, Wall Street was closed down. It was forced to close down to prevent the spread of COVID, and part of their business required that they have sort of a Wall Street experience. And so we were able to look through their gross receipts, see that it was more than that nominal portion, and essentially make this story to the IRS that, hey, this part of their business was an important part of their business. It was more than 18% of their revenue in 2019, but you can specifically see they declined. So even though they didn't hit that 50% decline, they still showed that sort of nominal portion, and then that they were specifically subject to a government order.
Now we get into let's talk about money, the wages.
Yeah.
How do we figure out who actually qualifies?
Yeah, so this is sort of the part 2 for the ERTC. Part 1 is trying to qualify specific periods of time, those quarters, for 2020 and 2021. But once you get those quarters, you need to sort of generate the wages, because we've had a few clients that I had IAs with that essentially qualified, but they didn't have any employees. So the ERTC, again, is that reward for keeping employees employed during times of hardship. And so if you don't have sort of those qualified employees, you shouldn't be able to get the credit, because it's not sort of rewarding sort of that good behavior that the IRS wants to see.
For those of you who don't work with us, we refer to an IA as our initial assessment with a client. It's an internal lingo. You know how it happens. You get caught up with your internal lingo.
Yes.
So on to determining the qualified wagers employer size.
Yeah. So one of the first determinations that we like to do is first see whether or not an employer falls within a smaller regular sized employer or a large employer. And again, kind of going back to what I originally said, there is no hard cap with the ERTC, but there is a soft cap with the large employer rules. And so the first thing that we have to look at is, again, going back to 2019 and that sort of year before COVID hit, how many full-time employees did a company have? And again, the IRS has sort of that number of employees and that number of hours specifically listed. So it's 30 hours a month, or 130 hours for a month, or 30 hours a week. And so that once you kind of get that full-time employee, you can do that count. So more than 100 employees in 2019 is 2020's sort of large employer scale. 2021, it's 500 or more.
All right. This is complicated, you guys. I don't know if it's just me. Carl doesn't seem to be having any trouble, but I think it's a lot.
Yeah, so this determining qualified wages, again, this is straight from the IRS website. Specifically, we have sort of that 10,000 per employee, 50% of the qualified wages gets you 5K per employee per year for 2020. But in 2021, as I said earlier, you have sort of it's 70%, so you can get a maximum of 7K, and you can get it for each quarter. So that's about 21,000 at a maximum you can get for 2021, which really makes 2021 the year to aim for the ERTC. There is the Social Security and Medicare, and that kind of goes into sort of what the credit is applied to first before getting into sort of that tax-free refund.
And then we throw family into the mix, and it becomes a whole different rules of engagement.
Yeah.
Rules of qualification.
So last August, and specifically in Notice 2021-49, the IRS did clarify the related individual rules. So essentially here, what the IRS was saying was that the owner of a company, unless there's a few specific examples, but normally the owner of a company and his sort of first dimension of relatives are not to be included for the ERTC. This is sort of one of the more controversial opinions by the IRS because it essentially knocks out many sort of mom and pop shops who were specifically affected. But the rules are the rules, and so we specifically determine who are the related individuals are, and we have to essentially carve them out of the study.
That is kind of tricky when it comes to a family-run business.
Mm-hmm.
And large employer, which this one is another tricky part of ERTC.
Yeah. So I may have jumped the gun a little bit and kind of explained it before, but we kind of have the rules specifically here just sort of for your record. And again, it's that more than 100 in 2019 for 2020, more than 500 in 2019 for 2021.
It is important to note, though, the actual definition of a full-time employee. A full-time employee, at least as considered for ERC, is one who works 130 or more hours in a month, or 30 hours or more per week. I think most people make the assumption it's a person who works 40 hours, standard full work week.
Yeah, and this is just to kind of catch those that kind of work just a little bit less, but are still sort of given the full sort of like benefits and pay.
What we've noticed with like a lot of payroll providers who will take care of an employee retention credit, they don't necessarily do the full analysis. They do more of a general analysis, so they can often overlook this this rule. And someone who is a large employer, or someone who looks like a large employer from like employee headcount, is in fact a small employer, and they would qualify. So digging into the details, especially in this, I mean, it's probably always good to look at the details, but in this instance, it can give you some cash back for ERC.
And our consultants here at Leyton, they're very sort of well versed with this rule. We have a specific part of our own sort of personal workbook that kind of works through it and just follows all the IRS rules. Again, this IRS rule is specifically from the FAQ that is posted online for the ERTC.
All right, Nathan, you're up. We have another poll. What type of employee? Oh, sorry. What type of employee cannot be included in the ERC calculation? A pet, a payroll pet, part-time employees, related individuals, or religious leaders? Let the clock begin. Where our poll went.
All right, we'll give everybody about 30 more seconds.
All right, 30 seconds, guys. Who's leaning towards payroll pet? Have you guys ever seen a pet on the payroll?
All right, get those last couple of votes in. few more
Nathan,
seconds.
do you mind just reading the percentages to
No
us? We've lost our
problem.
ability to see it and I don't know how to get it
problem.
back.
Yeah, all right. So we're going to close and share. We got what type of employees cannot be included in the ERTC calculation. 39% say payroll pets, 9% part-time employees, 44% related individuals, and 8% saying religious leaders. Back to you.
All right, 39%, you guys.
So unfortunately for pets, this is sort of a human's credit, but you can also, it's sort of a trick question because religious leaders could be also not included for the ERTC, specifically because many religious leaders in the United States do not pay payroll. So there is a sort of an election, so they can be included sometimes, but not all the time. And then related individuals, as you know, cannot also be included. But part-time employees, as long as they receive like a W-2, they can be included. So that's sort of a trick question for you there.
That was all Carl, guys. He wanted to put in trick questions for you guys. And I think we actually have another polling question right on the back of that. We want to make sure everybody's paying attention. So if you don't mind, Nathan, to launch that poll again.
No problem, that is up.
Thank you. So polling question number 4, which of these individuals is not considered a related individual for ERC purposes and can be claimed as a qualified employee? An employer's spouse, the employer themselves, a grandchild of the employer, or a business partner? All right, we'll let everyone think on that, submit their answers.
Give everybody about 30 more seconds. Perfect.
Last time we did one of these, it revealed that some people Google their answers. I don't know how easy it is to Google this one. I would never do something like that.
If you know the right place, it's there. Again, all this information is found either in the notices or in the IRS FAQ. So just a hint. But I don't know if you can search for it in 1 minute.
No, if you can, we want to talk.
Perfect. All right, everybody get those last couple of votes in. 3, 2, 1. I'll close and share the results. And we have 8% saying an employer spouse, 14% the employer themselves, 17% of our audience saying a grandchild of the employer, and 60% saying a business partner. Back to you.
60% correct?
It's the business partner. So you can kind of think of it within the IRS rule of being sort of lineal descendants. So that's the grandchild, the employer themselves, unless there's like a specific caveat where they have no living relatives, they have to be included. And then the employer's spouse. You can kind of think of the idea of both blood and marriage would include yourself in sort of a related individual. So.
All right, now we'll move on to the company aggregation rules.
Yeah, so this is again one of the big parts where we see a lot of confusion. Essentially, with the aggregation, you are required to include specific types of companies. So these are either parent-sub relationship companies, brother-sister relationship companies, and essentially sort of like hybrid. And so the parent sub are basically, you can find it within sort of the rule set of 52, A and B, and then brother sister, there's another set rule of 414. And so just kind of going through those rules, but the IRS specifically has sort of the information that you're looking for in there. Now, again, kind of going to company aggregation rules continued. That sort of benefit of the aggregation is that if one of the if one of your entities is shut down, then they can all claim it. So this is another sort of section. It's the permissive merger rule. So this is sort of a sort of gift from the IRS, if you can kind of think about it like that, where sometimes you have businesses that acquired another business. And if you kind of look at it at a declining gross receipts, it hurts the business in sort of a comparison because you're essentially swallowing up a new business, new income. But the IRS does allow you to sort of include that income from before the company started. But again, this is a permissive merger, so you have to be active and essentially add that to your calculation. It's not required, but it's permissive. And so that's another thing that at Leyton we specifically highlight this rule and make sure that it's followed to the T.
So just wanted to chime in before we go to the next slide. We've got about 15 minutes left. So we probably will not have time for a Q&A because we have a decent amount more to go through. So please put your questions into the chat box, click the link and schedule time with us if you need more information. And back to the show. Now we'll discuss the interaction with other tax credits and specifically the PPP loan.
Yeah, so the PPP loan is probably the most important interaction, specifically when the PPP loan was forgiven. If those of you that kind of know the ERC rules, originally, if you took a PPP loan, you weren't allowed to claim the ERC. But in 2021, the IRS did change that rule and basically open up the ERC for a lot of other companies. You can kind of think of the relationship between the PPP loan and the ERC as the ERC being sort of that icing on the cake / reward for sort of that extended period of time. Because when that PPP loan was forgiven, or if you applied for forgiveness, it created a benefit situation where you're already getting a benefit from the payroll for the PPP loan, but you're also getting a benefit for the ERC. And so there can't be an overlap between those two. And so you specifically have to make sure that there is sort of no double benefit situation. And that's another thing that we pride ourselves about, doing sort of the due diligence of going through and accounting for sort of every cent of the PPP loan to ensure that there is no overlap. So one of the sort of the nice rules with the PPP loan is that you don't need to include payroll costs. And again, this kind of goes to that sort of the IRS only wants to account for that double benefit situation. And so non-payroll costs like rents, mortgages, and utilities, those do not need to be included. And it's actually really nice that you can minus your PPP loan by those amounts first before you get to sort of the payroll amount, according to example 4 within the sort of PPP loan interaction in notice 2021-20. Yeah, so again, the interaction with the PPP loan, the IRS does give sort of a caveat to that interaction period, that covered period of time, and this is what we call the excess credit. And so it's essentially like icing on the cake. So you already got a huge benefit from getting that PPP loan forgiven, but sometimes companies did not account for all the PPP loan to pay off sort of that payroll period. And so essentially, if you have more sort of payroll costs than the PPP loan that was forgiven, there is sort of an ability to get additional ERTC during that covered period. That's one of the things that Leyton is very good at. We've designed our workbook to account for this very, very accurately, either government shutdown or declining gross receipts.
And how about non-payroll?
Yeah, so again, this is just kind of an example that we're going through. We are a little bit short on time, so I don't want to sort of talk too much about this, but this is one of sort of the common situations that we deal with here.
All right. Well, now we can get into the actual federal income tax wage deductions.
Yes, so this is one of the most important rules to account for. This is only for for-profit companies, essentially to, again, avoid that sort of double benefit claim. The IRS essentially makes you sort of pay a little bit, but you end up getting a huge reward in terms of you have to reduce the your income tax wage deduction for that year by that sort of credit amount. And what this sort of exchange allows is for you to get that sort of tax-free refund in the end. And that tax-free refund, again, it's tax-free as long as you kind of do this sort of exchange. But what we found sort of in our examples that we've handled is that it's about a 4 or 5 to 1 benefit to cost ratio. So it's always sort of important to sort of know that there is this cost, but the benefits far outweigh the costs of essentially paying for that deduction.
Next up, the 941 form, which is probably a a number of people have heard way more in their life than they had ever had before ERC.
I know I have. So the 941 is the form that you use to specifically claim the ERTC. The 941X is a quarterly form, and you essentially show any sort of changes in payroll. And within the 941, the IRS had set up the way to claim the credit. Those are sort of lines 18, 26, 30, 31, 33, and sort of just going down there. But essentially, to claim the credit, you need to put the credit that you're claiming, either not the refundable or non-refundable portion, and then you have to put in the wages that you use, the qualified wages and the qualified health care. And so that's kind of the sort of formula that the IRS looks for.
Now, what about wages for which ones can't be used for the credit?
Yeah, so these are specifically on the IRS website. These are the different types of credits that you can't take. So there's sort of a negative interaction. So you kind of also think the Family First is one of those where it created this sort of payroll benefit, because if you got sick from COVID, companies could sort of give you that period of time to recover, but your that sort of payroll period was forgiven. And so it creates a similar double benefit, but not as big of a double benefit situation as the PPP loan being forgiven. Family, paid family medical care, the workers opportunity credit is another one that's listed. Now R&D, and again, Leyton is a R&D sort of first company, although we've also branched into the ERTC, but there is a interaction between the R&D and the ERC, and you have to specifically make sure there is no overlap in that.
So Carl, if you're a CPA firm that's not working with Leyton, and you have a client that's claimed one of these credits listed here, how easy is it to figure that out? Are you seeing CPAs who aren't aware of this and sometimes maybe double dipping, not on purpose, but?
Yes, we've seen that many, many times. We specifically think that the IRS does sort of focus some of their audit on these types of credits. And at Leyton, we doubly make sure that there is sort of no sort of overlap between any of these credits. We take a very conservative approach, and we just ensure that the IRS has no questions whatsoever between all these interactions.
So for CPAs out there who are taking this on, it's a word to the wise. We have a feeling that this is going to be audited because the statute of limitations has been expanded.
Yeah. So as you can see, normally the statute of limitations for a 941 is 3 years, but because the IRS has prioritized getting these refunds out, they've extended the statute of limitations to 5 years. And so these 5-year period, essentially after you file that 941. And so it could always go up to like 2029 that you could get a letter from the IRS saying, hey, we assessed your ERTC refund, and we think that you actually got too much. And suddenly you're going to be sort of jumbling and trying to get all your records to defend your position. At Leyton, we sort of hope for the best, but prepare for the worst. We prep and keep sort of all our records for that period of time, and we do provide that sort of audit support just in case the IRS does come knocking.
All right, let's go back to the topic of the recovery startup business.
Yeah. So the recovery startup business was a little bit sort of later to the party, but it was sort of the idea that there were certain companies that had sort of the unfortunate timing to start during COVID, but they kept on going. They kept their employees employed, and so this is sort of that third mystery sort of path to that ERTC credit. But the IRS was specific that the recovery startup could only be it's only for 2 periods of time, so that's Q4 of 2021 and Q3 of 2021. It's capped at $50K, and there is a average annual gross receipts requirement that you cannot go over essentially $1 million on average. There is also a sort of specific rule. If you do qualify for the ERTC the normal way, you're supposed to take it the normal way.
Oh, okay. Well, here's an example of a client that we worked with. They were founded March 1st of 2020. they had 800,000 in gross receipts. They had 8 employees and all would max out at the 10K. And then they ended up getting back 56,000 per the recovery startup business qualified quarter in 2021. And it was capped at 50K.
Yeah.
Because they had the PPP loan. So still, I mean, what an amazing amount of money for a business to get back so early on.
And you don't have to worry about the declining gross receipts or the government shutdown sort of path in this case. As long as you started after that February 15th, sort of that's when the IRS considers COVID have started, you can look and see if you can qualify for the recovery startup.
All right, Nathan, this is the last polling question, we promise. Get your polls ready, folks. When is the latest day that you can claim the ERC? December 31st of 2021, October 31 of 2022, or October 31st of 2024?
Thank you so much. That is launched. We'll give everybody about 30 more seconds or so.
The silence is deafening. I can't handle it. I know people need to think, but.
All right, everybody get those last couple of votes in. 5 more seconds. And we are going to close. And I'll share. All right. 14% of our audience saying December 31st, 2021. 32% saying October 31st, 2022. And 53% say October 31st, 2024. Back to you.
It looks like the majority of you were paying attention. It is the third option, October 31st, 2024. You can kind of think about it with the 941 again in place. The 941 is the way that we claim the ERTC. And essentially you have that sort of 3 years and 1 month. That's the kind of the way to think about it from when the quarter finished. So the third quarter, the IRS stopped the ability to claim the ERTC on the third quarter of 2021. So that's September 30th, but you get a sort of an extra month to file that 941 originally. And so you got that 3-year period from that October 31st period. So you get 2024.
Well, thank you, Carl, for your awesome information. Thank you so much to CPA Academy for having us here today and getting 1,000 and more to listen to our presentation about ERC. We really appreciate it. We are looking forward to speaking with many of you and getting your questions answered. So sorry, my slide won't go to the next page, but
Maggie, why don't you click unshare and then share your screen again, and it should reset.
It's just a thank you slide, so it's okay. But thank you guys so much. We're coming right on the hour here. We look forward to speaking with everyone if you have any additional questions, and thank you.
Perfect. Maggie and Carl, thank you so much. Thank you so much to Leyton for a fantastic webinar. I'm responding. There's all these thank yous. Awesome presentation. Thank you. Thank you. Great info. Lots of exclamation points. So once again, Carl and Maggie, thank you so much. To our audience, thank you so much. Thank you so much for attending. We'll do our best to get your credit processed. You should see that by tomorrow. We also record this session. We'll send you that archive link a little later today. Thanks so much, everyone. Hope to see you all at future webinars.